Hello. Can you hear me?
Yes, we can.
Okay. I apologize for my tardiness. We've had some major issues trying to get into this bridge. So there's a lot of people trying to get on, but how are you doing, Brian? All right. Are you on mute? Can you guys hear me?
Finally.
I can hear
Okay.
you,
Take
Anita.
so
Yes, we
many
can.
times to log in.
Oh my God, yeah, it's been crazy. Hi, you guys. This is Anita. I apologize for all the confusion. Daniel was supposed to give me access for admin rights, but I'm not sure what happened. Logging on was a lot different this time.
No worries. Thank you.
Yeah, so let's just give folks maybe a couple more minutes to see if, because I know a lot of people have had issues trying to log on. So let's just give people a couple more minutes. In the meantime, we have our speaker here. I think that's our speaker, David, right? Hi, how
I
are
really
you?
thought I was the only one having a problem getting in, so I felt bad being a little tardy. So anyway, I'm glad I made it on, and hopefully everybody else is joining as we speak.
Yes, 100%. Um, just in the meantime, do you want to just give, I was looking for, did you send me a brief intro or no?
Yeah, I had, but I can.
Okay. Okay, I will pull that up and I will read that because obviously that's probably the only thing that has worked. So let me pull that up. It came from your email, right?
Yeah,
Okay.
and if not, I can share my background, but whatever is easiest.
Okay. No, I have your bio here. So while people are joining, I'm going to go ahead and I'm going to just give a brief introduction on David, our speaker today. So he is a seasoned real estate entrepreneur with over 2 decades of experience spanning a bunch of acquisitions, development, private lending, and institutional capital management. His career is defined by a hands-on strategic approach to building businesses, scaling platforms, and generating consistent risk-adjusted returns across market cycles. David began his career as a broker, quickly transitioning into ownership and development, where I'm sorry, somebody just came to my window. Development, where he built a portfolio of value-added residential and commercial assets. In 2007, he co-founded Alpha Funding, a vertically integrated private lending platform that has since originated and serviced over 1.2 billion with a B in real estate debt. Under David's leadership, Alpha has become one of the East Coast's most active lenders, serving both retail and institutional investors through proprietary underwriting and service platforms. So you know what, David, just in the interest of time, I'm gonna let you tell folks the other things that are important.
Sure.
And then let's just go ahead and get started. And I want to make sure that you're able to share
Yeah.
your presentation. So why don't you go ahead and pull that up? But this group is in no way a group that provides investment advice. We just are strictly here for educational purposes. So we don't endorse or not endorse anybody who comes in to talk. That's the spiel that Daniel usually gives. And in the meantime, I'm going to go ahead and look for the record button. So I will find that so we can record this session. And then
It's
other than
already
that,
recording.
okay. Yes, I do see that. Okay, so other than that, with no further ado, let's go ahead and get started.
All right. Well, thank you very much, Anita. I appreciate it. And again, thank you everyone for joining. Hopefully the next half hour or so, I can provide some useful information, insight, and knowledge to a space that I'm very passionate about. Just to quickly finish up, as Anita was talking about, I own and run a private lending company, but about 9 years ago launched a real estate private equity group called Lucern Capital Partners, where we own and manage assets, primarily multifamily and industrial, with a heavy focus on industrial at this point in time. I'm going to kind of talk a bit about what small bay industrial is, why it's so interesting, some of the comparisons to multifamily assets. There's some of the good things that you think about when it comes to multi without some of the negative things that have been impacting the industry. So I think that's interesting and helpful to hear about. So I'll kind of move through this presentation and then open up for some questions at the end. So what exactly is small bay industrial? Most of you may already know, but it's kind of, if you've driven through an industrial park in your area where you have buildings that are cut up into smaller tenant bases, maybe a pull-up drive-in garage bay door with a small office in the front. Sometimes they're housing service-related companies, sports-related companies, car, auto, manufacturing. But these buildings typically are about 100,000 square feet or less. Probably a sweet spot is around 50,000 square feet for small bay. And what's unique about it compared to what most people think of when they think of industrial, which are these massive big box buildings that you could be driving 30 seconds past on a highway and still not, finish passing the building, is that these are made up of small tenants. And it's kind of similar if you think about retail, like you have your retail, your neighborhood retail that has your like pizza place and Chinese restaurant, hair and nail salon, things that service the rooftops in that area, the homes in the community. So in industrial, this type of product really attracts what's kind of akin to that for retail. This is small businesses typically taking spaces between 1,500 and 2,000 square feet. The businesses wide, are a wide gamut of businesses, like I mentioned, and I'll touch on that a little more later. The leases tend to be shorter in duration than a big box lease, where you may have 10, 15, 20-year leases. These are anywhere from, on the short end, 1 to 3 and possibly 5-year lease terms, which gives you an opportunity to mark to market when leases expire. You then can move rents up, and I'm going to talk about where the opportunity is in buying and owning these types of assets if you're going out and looking to acquire this. But the lease terms gives you an opportunity to push the rents up, and you can stagger them over periods of time to really protect cash flow. And the upkeep and expenses on it are very minimal compared to a lot of other assets. Many times these tenants are what are referred to as triple net lease, where they're paying for all the maintenance, common area, taxes, insurance. So the variable rate cost to you as an owner, if you own a property like this, is very minimal, and it helps you, project better what your numbers are going to look like. So just some commentary. It's been a very strong performing asset, probably the most stable asset at this point in time. There are others that are strong, but there's a lot of weakness in obviously multi and office. Retail has been doing fairly well, but having, some areas having challenges. So continued performance through COVID and a lot of resiliency, despite some of the challenges that we've had. There's a big supply issue, and I'm going to talk about that, which makes the space very interesting for investors, including ourselves here. So, long. So as I was talking and explaining about what these assets are, they're really vital to the neighborhoods and the communities that they're close by to, because they're typically servicing residential type businesses. It could be uh, delivery and last mile delivery, different types of even stuff from like chiropractic to gyms to car services, from tinting uh, to mufflers and tires, whatever you can think of, roofing companies. And we're expecting these trends for the market to remain very strong for the next few years because there is a massive supply issue. There isn't like there isn't a lot of wind behind the building and development of these assets. The government obviously wants multifamily and housing to solve housing issues. There are mandates in many states for building affordable housing and growing that, where here there was a supply issue in multifamily for some time. The assets were moving up very well, and there was just so much new inventory that flooded the market that created some of the challenges that you see with occupancy levels and things of that nature. So we think that it's going to remain a strong and good investment strategy for us and what we're doing at our firm. Little more on that as far as vacancy. Most of these tenants, if you're turning over a space under 5,000 square feet, you're like 3 months or less. You have, in many areas, you have 97 and above% occupancy levels. If you're looking at markets that are densely populated, you're likely going to be in a good position. Some of the more tertiary markets, you could have a little bit uptick in vacancies, but if you're staying in core markets or in high trafficked areas, you're going to have that continued demand. So how does it fit into the bigger picture of industrial? And there's a little chart and some stats here. I think what's interesting is that they only account for 5.5% of the deliverables over the past decade, but yet it makes up 42% of the of all the industrial inventory. If developers are going to put a shovel in the ground, they want to go as big and as large as they can to get economies of scale, and more higher dollars and more margin. It's a little bit challenging to build, just the cost of construction and the cost of land, and in many states, just the approval process can be challenging and costly as well. So all those things added together make a high barrier for new inventory to hit the market, thereby like creating that demand that's so strong right now. So I talked about this a little bit about the record low on the demand for these types of properties. You can see down below, it's a breakout of different square footages. This has some bigger square footages, 10 to 50,000, but you could see they're down in around like the 3 to 4% range at the end of 2023. So the small bay units typically include an open warehouse and then like a small office. So there's not much to the space. There's not a lot of renovation. If a new tenant comes in, usually if there's any fit up costs, they're taking care of it. So it helps with planning. So when you're modeling out dollars that you need for operations, if you're buying an asset like this, you're gonna look for some vacancy period and brokerage fees. You're going to have minimal dollars that you're going to have to set aside for renovations. So again, the lease terms are attractive in that a 3-year period gives you an opportunity to mark up to market. And we're finding right now that there's still a lot of value add, where maybe 7-8 years ago in multifamily, when things were starting to move up, there was little inventory, and people, they were bidding the properties up and continuing to drive cash flow down. These properties, are in a much different position, because you're coming in now buying these assets where you have families that might have owned like fractional ownership, that they haven't run these properties well over the years, or they have never just moved the tenant rates up. They tend to like mismanage these assets, and we're finding a lot of opportunity to buy mismanaged assets where the bump ups on the rents are tremendous on the first run, and then you're looking at more leveled bump ups like 3 to 5%. The point that I was making to back to multi was that back 7-8 years ago, it was a similar situation. There was a lot of old ownership, and you could buy assets and move the rents up very substantially because the previous owner hadn't really managed that well and pushed rents. So again, more on the tenant base, a big, diverse. This is actually a building that we own down in Charlotte, or right outside of Charlotte, North Carolina, that has like a little bit of like retail-esque on the front and bays in the back. But you have the diversity of tenants, and here, like, we have a gym that takes up space. We have chiropractic, we have a physical therapy, and then we have a kind of a combination of all different sorts of commercial type tenants. But again, staggering these lease expirations is really important to running these successfully and keeping the cash flow consistent. And where we see the opportunity is, again, these the smaller size assets, and I push 15 is at the top end of the assets that we're looking to buy. And the reason why, and if you're out looking at to buy in properties on your own, you want to make sure that that you have this set up for the small bay, that as you get more square footage and go up in price, they tend to have bigger box tenants. And although that's a different strategy, there's more risk in that, because these bigger box tenants, if they move out, it can take much longer to lease back up the space. So that's why staying at this like kind of 15 million and 100,000 square feet and under is a good place to be in the market. And there's less competition from very large institutional investors. I feel like they're starting to find their way into the cracks because there's good yield. And we'll see what happens there. But right now, a lot of it is more small private equity like ourselves.
Can I stop and ask a question?
Yeah.
Okay, so in terms of the bay, so you pretty much buy the warehouse space and then you rent out the bays. Is that what I'm hearing?
Yes, correct.
Okay, and then when you say small bay, what is like the square footage of that versus a medium-sized bay versus a large bay, just so we can give people an understanding of what a bay actually looks like?
Sure. So referring to small bay, you could be looking really up to 10,000 square feet. So from 1,500 to 10,000 square feet would be considered small bay. So we have properties where we'll have a 10,000 square foot tenant, and we'll have a 3,000 and a 1,500, and a conglomeration of different square footages. Mid bay is kind of when you're getting really maybe starting even larger, like 20,000 to 50,000 square foot type tenants, maybe even considering up to 100,000 or sorry, 200,000, and then like the big box retailer is industrial properties generally, pushing 500,000 square feet and above.
Okay, that's a big bay. Okay, thank you.
Yeah. Well,
And
those are
for
like your Amazon hubs and distribution centers and things like that.
Okay, thank you. And for those online, feel free to put any questions in the chat. I can interrupt them and ask them needed.
Yeah, I'm happy to take any questions. I had like 2 pages left here to go over some bullet points, but happy to jump on questions and answer whatever you may have.
Okay, we can go ahead.
Okay, so there's the reason why there's such a demand is because as population grows in these areas, you need more of these service providers, vendors. You have a lot of onshoring and manufacturing that's coming back. Like we have a embroidery company in one of our buildings. They have actually they're a little over 10,000 square feet. But you have light manufacturing and all these different things that are happening around e-commerce with the small distribution centers. There's a lot of need for this, and we see that demand continuing to grow. So kind of wrapping up, there's definitely a imbalance, supply and demand imbalance. We see that staying for quite some time. Like 2 to 5 years is, it's hard to kind of look beyond that. The sector is very inefficient still, because again, the institutional money hasn't found their way in to be able to aggregate it in a big enough way that it makes sense for them, and it's a bit more management intensive. Which, when you talk about multifamily comparable to industrial, the multi-bay or small bay is similar to the multifamily in that you're managing a lot more tenants. In multi, you're managing a lot more. So when you're used to managing and operating multifamily, going into small bay is much easier because it's a lot less headaches, a lot less work, a lot less staffing. And again, a lot of variable expenses that are not in your in your pocket, so to speak. So for a lot of reasons, it's a great place to be, to invest, and get good cash flow on these assets. There's really good high single-digit cash flows out of the gates that you'll see stabilize. Some of these things get into double digits. Obviously depends on what market and what asset you're buying, and how obviously the deals are underwritten, and the financing that you get. But that's kind of a range of what you should see if you're buying in this space. So I will open up to questions. Hopefully in all that there was some golden nuggets there, or it was helpful to provide you some of that info.
Yes, we do have a couple questions. The first one is from Suma. What does the investment process into the small bay market look like?
Say that again, I apologize.
What does the investment process into the small bay market look like?
So I guess I'd ask a question if you're asking is if I want to go in and do my own deals, and how do I get started and do that, or looking to invest in like with operators like my company and other companies that invest in these assets.
Okay, Suma, do you want to take yourself off mute and ask a more detailed question?
Yes. So are there any funds that are available to invest in this, or is this individuals going by themselves and acquiring these properties?
So I'm certain there are funds that are out there that raise money in the space. I'm not aware of any specific ones. There are definitely a lot of operators because of the sizes of these deals. A lot of the equity checks are between $3 and $5 million. They're not large checks, so it tends to it tends to be offered up as syndications. So like our firm, we syndicate a lot of the purchases that we do. And investors can look at those deals that we've done in the past and view new offerings as they come along. And if you're searching online, I'm sure you can find other operators that are doing the same as us. But there's, just like there was in multifamily, both funds and syndication groups, you'll find the same thing here in this space.
Okay, thank you. Another question from William is two questions. Is there a higher return on renting the larger bays? And the second question is, are the bays flexible or divided by hard walls?
So the bay, I'll start with that question first. The bays are flexible, and you can be moved, not easily. They are depending on the building, because some buildings will have truly flexible walls, others will have hard walls. So it depends on the construction of it. So it's not all or nothing on that. Just depends. And then as far as the other question was,
The other question was, is there a higher return on renting larger bays versus smaller bays?
you're going to get a higher return on the smaller bay. It's like you're being paid for the extra work, I guess. So people pay a higher dollar per square foot on a smaller bay than they would on a larger bay. And every market has different ranges of where prices are for each kind of range. But the bigger the space, the bigger the discount on the rents.
Okay, thank you. Another question from Maju is, what is the return on investment, and how long does the investment, what's the investment period? Like, how long would your funds be locked up if you went into, if you go with a fund?
So each operator is unique and has their own strategy. I can speak for ourselves in that most of our deals are 3 to 5 year, all planned with a 5-year hold. That could change if the markets change, but as of now, all the offerings that we've done and we see us doing in the near future would be a 5-year time period. The return profiles, like I always say, every deal is its own fingerprint. But in terms of return, sometimes there's a higher multiple because an IRR on a deal because a higher IRR on a deal because it's going to be held for a shorter period of time, but the multiple is lower. You could be looking at anywhere from in a 5-year period from like a 1.7 multiple to 2.25, and cash yields typically are somewhere from 6 to 9-10% stabilized. So that's kind of a range. Deal IRR, you're probably looking at ranges in the probably 14% IRR to 17% in that kind of range.
Oh, that's good. Okay. So another question is, are there specific states within the US that you focus on? And does California have advantages or disadvantages in this regard, from an opportunity perspective, and our ROIs based on the geo? So like across the country, like what does that
Sure.
landscape look like?
So we invest ourselves in the Carolinas, in Maryland and New Jersey. We're looking to grow further in some other states and on the East Coast. Every market is unique as far as the return on investment. I don't know a lot about the California market, so I don't want to speak out of turn, but I do know that they've some of the warehousing prices on the dollar per square foot have set records out in California, like three, pushing like 300 a square foot, 350 a square foot, which is insane to me. On the East Coast, you're kind of looking like, dollar per square foot on acquisition, your value add type stuff in the low 100, opportunities to sell north of 200. But I can't speak to the specifics of the return profiles or, what the market is like in California, because I'm not invested in that area.
Understand. Okay. Is return based on a distribution or cash flow model, or is it more of a capital appreciation at the end, or is it a hybrid, or does it vary?
It can vary, but I would say most of the industrial deals are cash flowing assets that have the ability for forced appreciation through the value add process. And when I say value add in this space, I really mean, there's not as much construction. Like maybe we come in, we have a 60,000 square foot property that we just acquired in Maryland, and we redid the entire roof. We had negotiated credit for that. So, you're looking at, I apologize. What was the rest of the question? I was getting off topic there.
I was asking, is it mostly a cash flow model? Is it a capital appreciation model? Is it a hybrid model? Or does it vary based on what the deal is?
Oh, so the cash flow is key, and that's something that we're almost always have in every deal. There could be opportunities where there's not cash flow, and those would have significantly higher upside on the deal. But all of these deals, even with the cash flow, have good opportunity for appreciation as well. So it's a combination of both.
Okay, thank you. And then what is your minimum investment needed to join one of the deals, join one of the operators, such as your company?
So each operator is different. I'd say, for us, depending on the equity raise, it's anywhere from a minimum of 50,000 to 100,000. So it's never more than 100 and usually never less than 50. But I think, with each group, it could be different. There might be folks that do 25. There might be folks that have minimums of, above 100. But because the equity checks in a lot of these deals are not massive, like they would be on a $50 million multifamily property, you usually have the opportunity to go in and, smaller check sizes than sometimes these bigger funds. You're looking at 250 a pop,
Okay, thank you. And Rajesh, Maju, and Brooks, thanks for your questions. I know I haven't mentioned the name who's asking the questions. So just to make sure we could kind of going back to the cash flow part of it, is when you say cash flow, is that monthly or is that quarterly?
Sure. So for us, we distribute quarterly. We do full investor reports and updates about the asset, along with obviously the distribution and the reporting with that. So like if somebody was interested, we could send them samples of our reporting and a deck from a recent deal that we've done to get a better understanding of who we are and what we do and what the returns look like.
Okay, I'm gonna insert one of my questions before I go on to Mohammed's question. And that is, so you have a lot of different properties. So do people invest in a specific property, or is it a fund of properties put together when they're talking about your investments?
Yeah, so we do on the industrial, we purely are doing them on a one-off basis. So when we have a new acquisition, we go out to our database of investors, obviously our current investors and new prospective investors, and then it's kind of like a first come, first serve basis, because we have you have a limited period of time. Once we move forward, we're already invested in the deal because we've spent money on on deal pursuit costs and things of that nature. So we kind of have to do it right at, in that period of time prior to closing.
Okay, so you do a fundraise per each acquisition, kind of. Okay, perfect. And then Mohammed's asking, and Mohammed, I might have you take yourself off mute to ask this question. That's a little long. So if you want to buy a smaller bay and you want to do a 1031 exchange and ask for time until 2 or 3 of your existing assets are sold, do smaller sellers show patience waiting for such exchanges?
It's interesting. We're doing a 1031 right now. Again, like with deals, each seller is unique, right? And so it's about what you can negotiate with them and get them comfortable with. This deal that we're 1031ing into, woman is extremely wealthy, family of real estate, owns a massive amount of properties in this sub-market, and has no debt on it. And she is like delaying everything. She does usually it could be the seller putting pressure on the buyer to move along and get the deal done. We want to close quick because we think we can acquire other assets from her and want to give her a good transactional experience. But it's really a discussion with that individual seller, if they're willing to wait and what their situation is. Also, some people may choose not to, at a certain point, you have to disclose if you're going in because you want to have it in your contract that you're setting up the 1031.
Yeah.
So hopefully
Okay. Yeah, and then also Mohammed wanted to know which websites do you look for such assets on? LoopNet, or are there other platforms that you look at?
So like LoopNet and CoStar, but we pull a lot of data and then we work with brokers that are local to the markets that we acquire assets in, and we'll actually give them targets to go after. It's really important to make sure that you have really good relationships with the brokers that control inventory in the market to be able to get off-market opportunities. And if you're bringing them lead sources to go out and call on, they become ingratiated to you, and taking care of your brokers is absolutely key. You can find stuff on these sites, but like if things are widely marketed through like a full marketing process, it gets very competitive, unlike other asset classes right now. So, one place you might kind of laugh at is that even on Facebook Marketplace, you just have to be careful because sometimes it's like people posting, these wholesalers that are posting properties that don't really own the property, or a seller that's just putting something out as a feeler. But once in a while you find that diamond in the rough, just a good deal, and they didn't want to go the other route of going down the broker path, and you can find stuff. But I always tell people, become an expert in the markets that you're interested in. Look at all the inventory, get the offerings on all the inventory that comes up through all the brokers, give them feedback, when nothing, when they're sending stuff out, just like we're all human, right? We want to feel like when we're doing our job, that people aren't annoyed that we're contacting them. Get back to the broker and let them know, hey, this deal seems way overpriced because of X, Y, and Z, or this seems biddable. Is there room in the number? Whatever it may be, they appreciate and they think of you. So I'd say look on those sites, but build broker relationships and be courteous to and respectful of their time.
Yes, brokers love feedback. Okay, another question. I'm going to merge a couple thoughts. So what are the risks for this type of an investment? And for the ones that you've done, what % of your deals have not panned out?
Sure. So I'll start with the percentage of deals. we've been doing this for 9 years. We had a fund for multifamily where we got hurt with, we had done like 17 deals prior, but we got hurt with a value add project with variable rate debt and had like a very significant loss in that investment. Outside of that, every industrial deal that we've done, we've we've beaten our pro forma projections, and all of the assets are performing ahead of it. What happened in the multifamily, many people may know or may not know, but there was a multitude of challenges that happened coming out of COVID. The interest rates flying up at a record-breaking pace and pushing on cost of debt for any value add projects, because you couldn't have stabilized debt if you're doing value add. So that was a challenge. Insurance costs and things of that nature went through the roof. But all of the industrial investments are performing very well, and we don't see structural issues in the space like that started to happen in the multi, and we saw the cracks coming and tried to get out in front of it. But unfortunately, sometimes you can't. So those issues don't exist in the industrial space, where the risk, I think the biggest risk that lies in the small bay industrial is a very strong recession. If small businesses get hurt and go out and consumer spending goes down drastically, it could pinch some of the tenant base, right?
Yeah.
And that's a real market condition that could affect us. I would say that with where we're buying these assets, there's a lot of downside protection in having to deal with dropping rents or moving forward with more vacancies than you like. But with that said, the interesting part about small bay is that the mid bay tenants, if they're struggling too, they still may not be going bankrupt and out of business, but they still need space, but don't need as much space. So the small bay can benefit from some downsizing, which offsets a little bit of that risk. It's hard to, measure the specifics of that, but I think outside of it, I don't see issues with, most of the time we're getting stabilized debt on these assets. So I also don't see a version of interest rate environment shooting up again 5% from where we stand at this point. So I think interest rate risk is kind of, off the table for the time being. So like I said, going back to it, you're probably looking at the biggest risk just being, the
Recession.
recession. Yeah.
Okay. And then what are the tax advantages of are there some tax advantages versus other investments?
So it's still a tax efficient investment like any real estate through depreciation. As I talked about multifamily has, we do cost segregations on every property, but there's more pieces to the puzzle in an apartment building that you can get on other depreciation schedules. Although now, depending on whether, some of the big beautiful bill moves forward with the 100% bonus depreciation, owning real estate is going to be a huge benefit, just because of that. So.
Okay, thank you. Okay, and just to answer Maju's question about the minimal capital investment, if you want to go solo, I think I heard you say 50,000.
Yes. Yeah.
Okay, and then how adaptable is small/large bays between different tenants with different space requirements? And what percent is spent on the remodeling versus adapting the space to new tenants after the lease is up?
Yeah. So Usually there's not much at all because they're being delivered like a shell. And so maybe people are bringing in rack systems or heavy printing equipment. Maybe if they're doing automotive, they have like a jack system, something like that. So, 9 times out of 10, you're not having to do anything. We had a building that it was kind of on an incline, and so there was bays downstairs, and there was upstairs, there was like more office, and we had tenant that was taking over some additional space on the downstairs through the upstairs office, and they wanted to have a stairwell built, so we connected the two spaces. But generally there's not much in terms of turnover. The tenants take care of it.
Okay, so is this a triple net or double net lease?
So we want to get everything in transition, everything as per our allowance on how the leases are set up. We move them to triple net leases.
Okay.
Many times when we're buying an asset, there might be modified gross leases or double net or triple net, and a variety of them in them, but we eventually move everyone to triple net.
Okay, I like that. Okay, can you speak a little bit about your process to acquire or get a property, acquire property, your acquisition process?
So we have my partner oversees our acquisitions, and we have him and another acquisitions analyst that just underwrites deals all day long. They're working on, coming before our committee to decide whether we're bidding on stuff. And then once we bid on a property, obviously, if we wind up winning it, we're doing a lot of due diligence in advance, pulling the rents, getting insurance quotes, getting debt quotes, all that's happening prior to us even winning the deal. So we're going down, walking the property, reviewing if they have a full data room, reviewing all the leases, putting together a lease abstract internally so we know when the leases are expiring. Like we put like kind of a graph in our offering decks of the lease abstract, and we kind of start putting all that stuff together so that we can bid with confidence on the deal. Obviously, once we win a deal, we typically get it fully under contract and start due diligence before we go out to our investors. And then we're typically raising in a 30-day period while we're finishing due diligence, and then close shortly thereafter.
Okay, and then it kind of leads me to my use question about how much of the deal is the tenant management part of it, and what happens if rents are not collected on their, people aren't paying their rents.
Right. So we rule with an iron fist. I know I sound soft here. No, I'm just kidding. We manage our own assets, and we have systems and processes set up for that, and we're writing the tenants consistently that need to be written. And if if they go beyond the timeline, we file for eviction. And these guys are personally guaranteed on most of these deals. We have PGs from the owners of the entity. And they're on the hook for the rest of the rent. So we'll work with them if need be to try and bring somebody else in, but we act quickly. But we have like a 98% collection rate right now. We do really well with it, but obviously if we hit a recession, that could be more challenging. But it would just affect the cash flow, obviously, of the property. And so if you had a point where you weren't collecting rents, it could impede cash flow. So that could be a result of that.
Okay, perfect, thank you. Okay, so I know we have about 5 minutes left. There's a couple more questions, but I just want, and this might answer the question. So take me through a model. I come to you, I have $50,000 I want to invest. I give you the $50,000, you invest it. What does it look like on my part? When do I start getting paid? What is the risk compared to things like, equities or crypto or something like that? How do you compare it? Like, what's the risk level? Is it high, medium, or low? Or walk me through that in terms of what would a typical payout be on a quarterly basis and how long and
Right. I'll use 100,000 just because it's an easier number to do that.
perfect.
Again, every deal is different, and the risks are the same for the type of stuff that we're buying, and we disclose that on every deal. And there's lots of risks if you've ever read a private placement memorandum, that run a wide gamut of stuff that are like kind of catastrophic type issues that could be risk. But generally, the risk is, like I said, you're renting places out. Your business is to rent out space. So if tenants aren't paying and you can't make payments out to the investors because there isn't cash flow, then you're not getting the cash flow. Worse than that could be, obviously, if you're, you don't have enough cash flow to cover the debt, then it becomes a whole different problem. Now, the odds of getting to a place like that are extremely low, but they're always possible. And again, the nice thing is that in this small bay space, the cash flows are like very strong for a real estate asset, which is great because you're getting distributed maybe an annualized, let's say 7 or 8% on your money. So 7 or 8,000 a year, 4 times, divvied up into 4 payments. But if some of the rents aren't getting paid or whatever, then it could eat into that. Again, in all of the deals that anyone is doing or should be doing, and what we do is we model for vacancies, and usually twice as long as it would take to fill a vacancy in what the market absorbs. So we kind of stress test these deals and make sure that we're being conservative in our assumptions. And as far as it's compared to other investments, it's a real asset. It's a tangible asset, opposed to crypto or stock. The markets don't typically swing as often or as frequently, and it certainly never happens as quickly. So, I mean, the positive is that, you get a cash flowing asset that has strong upside for appreciation because there's real upside in the rents, based on what's in the market. And, that you now have the ability to get these tax advantages that you don't in equities and other types of investments, that help offset that. So even though you're getting paid, let's say on that example, 7 or 8,000 a year, your K1 will show a loss from a paper loss from the depreciation. So even though you're getting paid that money in that tax year, you're not paying taxes on those dollars. Everybody's tax situation is different and unique. So as a disclosure, talk to an accountant, your own accountant, about anything regarding that. But, those are a lot of the benefits.
Okay, thank you. So I'm gonna do a couple things. I'm going to kind of close it out because we're getting to the top of the hour. But if you want to stay on a couple more minutes, I can ask the other questions I haven't asked you, if that's okay with you.
Yeah.
Okay. And then for those who have to leave, I just want to tell you guys, thank you for allowing me to moderate this in Daniel's absence. As you know, Daniel does a good job. He makes this stuff look easy. So thank you guys for your patience and logging on. And, it was a little rough, but I think we got there. And for those who are fathers or father figures, happy Father's Day. I hope you have a great Father's Day. So thank you guys. And definitely take yourself off mute. And please tell David, thank you. And then we'll continue with the last few questions.
Thank you.
David.
Thank you, Dave.
Thank you, David.
Awesome.
Okay.
Okay, perfect. So one last question. How many do we have left? So you said, how long have you been doing the small bay business? I think you said 9 years, right?
No, we started with multifamily 9 years ago. Bought our first small bay about almost 4 years ago.
Okay. Okay. And how common in the small bay market do warehouse owners get approached for selling where the transaction is one-to-one versus bidding?
I wish I had the data on it. I don't know. I can make a guesstimate. I would say, I'd say that maybe 35–40% could be done off market, like one-to-one. There's a
Yeah.
lot that happens in this space, and sourcing is part of the uniqueness of it. Like, so, and a lot of times these brokers that get people, the previous owner isn't as sophisticated where they want to go out for like a full marketing process that you might get from like a JLL or a CBRE. And so it's more common to them. So they hire maybe a local commercial broker or a commercial broker that's with a bigger shop, but they offer that, hey, I have a couple unique buyers. You mind if I go to them and we can see if we can make a deal? So a lot of deals get done that way.
Okay, nice. Well, then I think I saw in one of your slides your vacancy rate. What is your average vacancy rate?
Right now across our portfolio, we have 0 vacancies.
Wow, that's very impressive. Okay, and then a comment that's very impressive that 35% of one-on-one base sales. Thanks. That was a comment to say thank
And
you.
it's a guesstimate. That's not an official data point. Just to be just to be fair. So
Okay. And you can definitely acquire buildings that are already existing. You don't start from just raw land, right?
we have one asset in our portfolio that we built from the ground up. It's hard to do that because the building costs generally don't, the cost of the land development and building doesn't warrant it on an investment basis in a lot of places. So it's hard to find it.
Perfect. Okay. Well, I think, does anybody else have any questions? If you guys are still online, let's see how many, we have about 21 people still online. Anybody else have any questions before we wrap up? Okay. I don't see anybody asking any more questions. So David, I'm sure we will be following up with you. If you have not already sent your, are you okay sharing your presentation with Daniel for us to post, or?
Sure.
Okay, you can just send it to me or Daniel. Otherwise, or actually, you know what? You don't have to. We'll just post the video. So I don't think nobody's asked for the presentation material, so you don't have to do that.
Okay.
So
Great.
thank you so much for coming in.
Yeah, thank you. I appreciate it. Happy Father's Day to all the dads out there. And thank you
Perfect.
for having me on.
All right, we'll talk to you soon. Bye, everybody.
Bye.
Thanks.